Hello, and welcome to another episode of Freedom Ain't Free. My name is Hughey Sr. I'm the principal at ARC Financial Strategies. In today's video, we're going to talk about term insurance, whole life insurance, IUL, or index universal life insurance. Which one is right for you? So I spend a lot of time talking to my clients about the different types of strategies that are available to get you to financial freedom. And here at the Freedom Ain't Free channel, we talk about financial freedom, and we define financial freedom as income. So we want you to have $120,000 to $160,000 a year coming in from your assets. We say you need a $2 million portfolio in order to get that done. Now, what tools can I use to accumulate and grow my assets? And where does these particular insurance strategies fit into my portfolio, right? So at the end of the day, right, your coworker says you need to buy term and invest the difference, right? Your neighbor says you need to get a whole life policy, get the dividends, right? And then, your boy is telling you, man, you need to be your own bank, have this IUL and grow your money and not, worry about losing. And your question is which one of these do I need, right? Which story is the right story? Which story is the true story? So you got to get the wisdom, the knowledge, and the understanding of how all the financial tools and products work in order for you to know how to apply them to you. So first and foremost, make sure you click on the link in the video and get your freedom number. That's going to lead you to the wisdom and knowledge and understanding of all the products that you need. So let's talk about term insurance. Term insurance is like renting, right? So if you're renting a house and you're paying rent every month, you get to stay in the house as long as you pay the rent. The landlord gets to raise the rent at the end of the lease. And when you move out of the house, you don't get any of the advantages of the home, okay? That's term insurance. It's the least expensive way to access the life insurance product, right? Because it doesn't have any of the other benefits. It only generally pays a death benefit. So you are hedging with the insurance company that you're going to die before you built out this $2 million portfolio. The insurance company is hedging that you're going to live, and they're going to collect premiums during that window. It's called term because what the insurance company is agreeing to do is to keep your payment the same for a period of time. It could be a 1-year term, a 10-year term, a 15-year term, a 20-year term, a 30-year term. The insurance company is saying to you, we're going to hold the payment. Whatever payment we quote you today is going to stay the same for that window of time. Now, a lot of people think your policy ends at the end of the term. That's not true. What happens is the payment changes. Now, the payment changes so drastically that most people cancel at the end of the window. But in reality, the term policy does not end. The price just changes. So if you had a 10-year term, your price is going to change in year 11. Got a 20-year term, your price is going to change in year 21. What do I need term insurance for? Well, you need term insurance because you don't have a $2 million portfolio. You don't have $120,000 or $160,000 a year coming in. How is your family going to take care of itself? How is your family going to continue to do all the things? How are you going to transfer a legacy? How are you going to pay for education? How are you going to pay for Jordans? How are they going to pay for all of those things if your income goes away? So not only did they lose you, but they lost your income. Well, I can't replace you, but I can replace your income. So term insurance, put it in the same category as your car insurance, as your disability insurance. It's your what if. There are 3 phases of planning we talk about here on the Freedom Ain't Free channel: protection, accumulation, and wealth. The term insurance falls solely in that protection piece of the puzzle. It's there to make sure that if I'm not here, my family can maintain the lifestyle that we have put together up to this point. That's where term insurance fits. Now, you'll hear other gurus talk about buy term and invest the difference. What they mean by that is a whole life policy has a higher price, but it actually has lower cost. I'll explain that to you in a few minutes. But if my whole life policy's price is X and the term policy's price is Y, what they're saying is still plan on spending the X. Buy the term insurance, take the difference, and invest that into mutual funds, and you'll have a bigger asset than you would have if you had used the whole life strategy or the IUL or the index universal life strategy. Here's the problem with that thinking. That requires you to do 2 steps, and it requires you to manage both of those steps, right? So we've been focusing our attention on our career. I've been working 50, 60 hours a week. I've been going to meetings, I've been reading books. I don't have time to manage another portfolio that's designed solely to take care of my family if I'm no longer here, right? So that strategy requires you to do some heavy lifting, or it requires you to be working with a financial advisor that is navigating that path for you. Term insurance is designed solely for you to protect your income. Now, here's the thing. If you work with us and we help you to get to that $2 million portfolio, do I still need the term insurance? No, I now have cash, right? So it's okay to get a 10-year term or a 15-year term or a 20-year term, because at the end of it, I'm not going to need that strategy anymore because I've replaced that strategy with my ARC. That's how term insurance fits into your portfolio. Let's talk a little bit about whole life insurance, right? Whole life means that you pay for it for your whole life. That's what that means. Now, most insurance companies have designed custom whole life policies, strategies where you can shorten that window of time, but the insurance cost is still set over your entire life. So the thought process here is I lock in my payment for the rest of my life. I know exactly how much it is. It's not going to change. It's not going to go up. It's going to stay the same for my entire life. Secondly, a whole life policy is going to provide you with dividends, right? So if you're with one of the major mutuals, they don't have stockholders, they have policyholders. So when they make a profit, they return that profit back to their policyholders in the form of a dividend. Dividends are not guaranteed, but all your major mutuals have been in business for well over 100 years, and they've been paying dividends every year since then, right? Sidebar, Google ain't that old, right? Okay. But they also offer you a guaranteed rate of return on your investment, which is going to be a higher rate of return than you would get on any savings account, especially when you add the dividend on top of that. So your whole life strategy is a great strategy to accumulate money, and I like to call it my set it and forget it. In the other video that we talked about in the past, we were building out an emergency fund, a place where you need to get money from during financial hardships or during financial times. That's where your whole life policy can come into play. You can access this cash tax-free through a loan feature and use that to help you navigate through emergencies. You can also use it to support yourself during retirement, where you could take the dividend in the form of cash every single solitary year. And now you're through a loan feature, you're accessing the dividend and you're not paying any tax on that revenue source, right? And the interest that the insurance company is paying you is guaranteed. You're getting the dividend on top of that. So it's a great tool because it has death benefit. I'm transferring money to the next generation completely tax-free. I'm guaranteed that that policy is going to be enforced on the day that I die because I know how much the premium is. It's a part of my budget. Here I go cussing at y'all again. It's a part of my budget, right? So it's going to be there for the rest of my life. And I'm getting these extra benefits on top of that, where I'm getting a guaranteed rate of return that's beating any savings account rates of return that you can get for a long period of time. And I'm getting a dividend on top of that. So the whole life strategy fits to provide me with death benefit, give me a place to store my short-term emergency cash or any small amounts or even large amounts of cash that I want in cash. And I'm getting a guaranteed rate of return and a dividend. And most importantly, I can access those gains tax-free through the loan feature, right? So that's where whole life fits into your overall strategy, right? So it is a accumulation tool. So I got protection, I got accumulation. Now, whole life has a higher price than term insurance. And here's one of the reasons why I say term costs more than whole life. The price of a term policy is lower. But at the end of that 20 years, the insurance company is not giving you your money back most of the time. On a whole life policy, I'm getting all my money back plus interest plus the dividends. So in reality, the whole life policy cost me nothing. The term policy cost me nothing. Now, the whole life policy has a higher price, right? But overall has lower cost. What are you trying to accomplish? I'm trying to get to financial freedom, right? So I'm not as concerned about price as I am about cost. and I'm trying to grow some tax-free investment dollars to provide me with income that I don't have to work for. So your whole life strategy will fall into that place. All right, Joe. So now, what's the difference between the whole life policy and the IUL, the Index Universal Life Strategy? Everybody's running around now giving you these stories. Be your own bank. First of all, you cannot be your own bank, right? An insurance policy is not a bank. Doesn't function like a bank, isn't regulated like a bank. It's not a bank, okay? Secondarily to that, the difference between the strategies in the whole life versus the IUL is the gains. Whole life policies got a guaranteed rate of return plus a dividend. Dividends are not guaranteed, but the insurance companies have been paying them for a long time. On the IUL, you're turning over your dollars to the insurance company. The insurance company is doing whatever they want to do with that money. Whatever they want to do. You cannot pick the investment. They put the money wherever they want. What they're saying to you is they'll give you a gain based upon an index that you choose. Most of them are going to have multiple indexes you can use as an example. The day you take out your policy, the index has a value of X. 1 year, 1 month, depending on the strategy you choose, they're going to go back and they're going to take a snapshot. Has that index grown? Yes. Did it grow by X percent? Yes. Okay. We're going to give you a credit for your gain that year based upon the growth of that index. Does that mean that the insurance company puts your money in that index? Absolutely not. They can invest your money anywhere they want. They're just saying that they're going to determine how much of a gain that they're going to give you based upon the index. Index Universal Life. What does universal life mean? That means that the premium is flexible. Your whole life out premium is not. It's fixed for the rest of your life. Index universal life policy, the premium is flexible. You can put in more money, you can put in less money, you can move the dollars around because your money's not actually in the market. The insurance company can do whatever they want to do with it. So you can continue to put money in on a regular basis. Now, the insurance company is saying that you cannot lose money. You can't go backwards. So if the index you choose is negative that year, they're not taking money from you because the market was down. Why? Because your money was never in the market in the first place, right? So the insurance company can do whatever they want to do with the money. So what they're saying to you is, if the market's down, don't worry about it. You're not going to lose any money because your money's not really in the market. Now, what they're saying is, now, if the market's up, right, there's a cap on how much gain they're going to give you, right? They're not just going to give you whatever the market is up if you're not taking market losses either, right? So the insurance company is going to say up to this dollar amount, up to this percentage of gain is what we're going to give you. Anything above that, we're keeping for ourselves in reality, and that's their hedge against when the market is down. So where does an index universal life policy fall in, right? So if you want to get more gains than the guarantee and the dividend in a whole life strategy, then you could use an index universal life strategy. Carriers have caps up to 10 or 11%. And so you could get a higher credit rating or a higher gain than you would get in the whole life policy using the index universal life strategy. So if I'm a high earner and I can't put money in a Roth IRA, I don't own a business, I can't use a SEP or a simple IRA, and I'm looking for a strategy where I can grow money and then access that money completely tax-free, a whole life strategy, an index universal life strategy, those strategies will provide you with the ability to accumulate that money. So do you want your $2 million portfolio in a taxable account, or do you want your $2 million portfolio in a tax-free account? Do you want to put your general principal at risk, or do you want your principal to not be at risk? These are the strategies that you can use in order to help you grow and accumulate without taking on the risk of loss until you get that $2 million portfolio. Now you're in a better position to look and take on risk, all right? So what we want to do is answer this question for you. Joe, how much money do I need to save on a monthly basis in order for me to build out that $2 million portfolio? And which of these strategies work for me? The last thing I want to share with you about utilizing the insurance strategies is this. The insurance companies are looking at two things. One is your age, and the second thing is your health. If you're not very healthy, you're not even going to be able to use the insurance strategy for either protection or accumulation, right? If you're overweight, right, then the structure of that policy may not work for an accumulation piece of the puzzle. You need to be working with an insurance professional who can answer those details for you and make sure you get that thing designed properly for accumulation strategy or death benefit, depending on which way we're trying to put it together. So click on the link below. Get your freedom number, the exact amount of money that you need to save on a monthly basis to get you where you want to go. After you know that, then we can start talking about which one of these buckets do we utilize in order to get you where you need to go. And then we wrap it up with protection, phase 1, accumulation, phase 2, and then wealth would be your third phase. I want to encourage you on today. Click on the link below, get your freedom number, get yourself on a path to financial freedom on today. And remember, freedom ain't free. See you in the next episode.